So, if you're still trying to build wealth by doing everything yourself, picking stocks, timing the market, or hoping your 9 to 5 will somehow be enough, this is why investing feels so complicated and out of reach. You want to invest, but it feels confusing, risky, or reserved, or you think it's for the other people. Today, we're solving that problem. We want to break down how to make investing efficient, accessible, and realistic for every single person out there. Andrew Parrillo is here. He's the founder of Parrillo Investors, and he helps individuals invest smarter without the need to be an expert, a landlord, or glued to the market every single day. He wrote the book, Beat the Wealth Management Hustle, so you can discover what your financial advisor isn't telling you. And today's conversation is for anyone who knows they should be investing, but they want a clearer and calmer and more practical way to do it. It's really good to see you. It's nice to have you here. Thanks for being here today.
Oh, it's my pleasure. Thanks, Lisa. I appreciate it.
Yeah, I feel like when it comes to investing, there's a lot of people out there who are confused by it. Um, and a lot of people feel like they're late to the game. So what do you think is holding people back the most?
Yeah, well, there's no question that it seems that it's always uncertain. Okay, it's always
Hmm.
uncertain. And I've been doing this for a long time, investing other people's money for decades. Okay, and I had my own firm for 25 years, serving endowment funds and family investment offices, very sophisticated investors. And I've been through bear markets. Many people investing today have not seen a real bear market. But I've been through more than a couple of 50% bear markets now, and so it never feels quite right. But let's just assume, let's take ourselves back about 6 years, just before, almost exactly 6 years now, to when the COVID crisis hit, and the stock market was down from mid-February to mid-March, 35%, like 30 days. That was the fastest drop in history. Okay. And it was scary and terrifying. So anybody who had money in the stock market was rightly concerned about what would happen to their money, what was happening to their money. But 6 months later, the market was back to where it started to decline from. So if you were
Right.
patient and resolute, and you were confident about the reason that you were invested in stocks, then you did okay. And that wasn't that long ago. All right. It seems like a million years ago, six years ago, but it wasn't that long ago. And my dog is right here. He keeps bumping up against me. Sorry. But the Enzo, back off and come on. I'm gonna have to get you out of the room here. But the he just is anyway. So the point is that one of the things I think it's important for people to know is that they needn't be intimidated by investing. And just for example, if in the last 10 years, had they invested in the Standard and Poor's 500 stock index, ETF, exchange traded fund, which they can do for almost nothing through the major firms, okay? If they put $100 in, it would have been worth $395 at the end of last year,
Hmm.
okay? And that's 14.7% a year, and that's in their retirement account. So no taxes and dividends reinvested. In the last 5 years, if they had done it 5 years ago, they would have $199 at the end of last year. So they would double their money 5 years. Now, the that return, okay, and recently, last 5 and 10 years, is way above normal, way above average. Okay, the average for the Standard and Poor's 500, people should understand this, for 100 years, literally 100 years, has been 10.4% a year for 100 years. But we've also had long periods of time where it's made no money at all, or it's gone down. Okay.
Right.
And, people might remember the dot-com era of March of 2000 till I think it was 2.5 years later, the market bottom. Market was down 50%. The great financial crisis, which is more recent, which was 2007 to 2009, market went down 50%. Well, it came back. And not only did it come back, it came back so that now the market is 10 times higher than it was at the bottom of the great financial crisis crash. Okay, so and why is that? And we've had all kinds of uncertain things happen in the world, and certain things are continuing to happen in the world. The reason that that stock investing has been profitable over time is that corporate managements are incentivized to make a return for their shareholders through any environment. Okay, so they have to make changes in their business structure and strategies to make a return for their shareholders. And at some and over time, the stock market will recognize those achievements, okay, and reward investors for them. And that's what they should do. Think of it another way. If you are sitting there with, call it $1,000, and you're not sure what to do with $1,000, but you don't really need it anytime soon. But you don't want to take any risk. Well, the biggest risk when you're thinking about investing is not to take risk. That's the biggest risk.
Mm,
Okay.
right.
Because that $1,000, if you're sitting in a savings account, is not going to keep pace with inflation, even if inflation is only 2% a year. Okay. Or less, even for that matter. Because after taxes and you just won't make any money in savings accounts to speak of. But the stock market is the best place to be over time, over time. So just know that that's a fact, and you could do that. And what you're doing is you're saying, okay, I want to put my $1,000 into the S&P 500. So what they're doing for no, almost no fee at all, for 3 cents on $100, is a year. That is, and is they're hiring 500 of the smartest corporate managers in the world to manage their money.
Right.
That's the way to look at it. Nobody ever looks at it that way, but that is the way to look at it. So I want to tell people that they have an investment superpower. And what I want to do in this few minutes is introduce them to their investment superpower. And that is to basically understand the history of the stock market over a long period of time, not what it's going to do next week or next month or next year, because we don't know. And I would submit to you, nobody knows what it will do. It's volatile, and it responds to all kinds of things, but ultimately it comes back to the average, which, as I said earlier, is 10% a year.
Yeah.
The You have to be patient. So patient, knowing, having confidence that you understand the history of the stock market and being patient is really important. Um, One of the things um, that I've said in the book, and I'll say it here again, is you have to have a strategy that's durable, a durable strategy. You have to understand how much risk you can tolerate before you exceed it, because you don't want to get to a point where you're making a fear-based decision. Okay, so that $1,000 I just mentioned should be, aside and apart from any kind of concerns you have about, next year, even the next 5 years. Okay, just leave it there and forget about it. And so have a durable strategy, understand your risk tolerance. And I will say that people can do that, can assess that free of cost, okay, by going, I have on my website, there's a questionnaire. It takes 5 minutes to go through and it comes up with a score. And it's based on data analysis. It's not based on me saying, well, you're X years old, therefore you're an aggressive investor, or therefore you're a moderate investor, or therefore you're a conservative investor. Those terms they're marketing terms. They don't mean anything. But what this risk analyzer does is it comes up with a score. And the score for the Standard & Poor's 500 is 72 on a scale of 0 to 99. And what does that mean? Well, it means that over time, it goes through, there's a lot more detail that goes into this, of course, but we could actually project what's likely to happen to your money over the next 6 months with 95% certainty. And over the next 3, 5, 10, 20, 30, 50 years, however far you want to look. And it's based on past behavior of
Hmm.
investors. And the only thing we have to go on is the past behavior. And one of the things we know is that behavior doesn't change. And people are 2.5 times, according to Nobel Prize winning research, upon which this questionnaire is based, by the way, 2.5 times more concerned about losing money than making money. And I think most people would accept that proposition. That's a
Yeah.
behavioral tendency. And so we work that into this process. And the other thing that's important about the process is once people go through it, they come up with a score, then you can construct a portfolio allocation based upon that score. Okay. Whether you want to and how much you want to have in stocks versus bonds versus anything else for that matter. And that will give you a pretty good idea, a roadmap of what you can expect. And so that's the kind of thing that I do. The other thing that's important for those people with, any money and they want to go hire a wealth manager, an advisor, and many people do, they should understand that there's a cost associated with that. And the other thing people should understand as part of their investment superpower is to appreciate the power of compound interest.
Mm,
Okay. Now, just as an example, and I won't put many numbers in this talk today, but if you had $200,000 today and you put it in the market with an advisor with a 1% fee for 20 years and you made 7% a year, which is what most people assume they're going to make, about 7% a year, you would, at the end of 20 years, have 770. That you would, if you have an advisor, you'd have $641,000 at the end of 20 years on your 200,000. If you did it yourself, which I'm suggesting everybody could do, you'd have $774,000 or $133,000 more than if you paid an advisor 1% a year. Because most people are going to say, oh, it's only 1% a year. That's no big deal. It's nothing. No, it is a big deal. And why is it a big deal? It's not that you're paying on the 200. The first year at 1% would be $2,000. Yeah, well,
mhm.
let's see, 2,000 times 20, that's $40,000, right? No, it's $132,000 because it's the earnings that you're going to lose on that 1% each year it's invested. Okay, it's
Right,
taking 1% a year. So instead of making 7% a year, you're making 6% a year. And people can figure that out literally in less than a minute if they want to go to my website. And there's a fee calculator, and they put in three numbers: the amount of money they want to invest, the amount of time that they want to look at, 10 years, 20 years, 5 years, however long it is, the return that they expect to make, whatever that may be, and the fee that they expect to pay. And it'll give them literally in 30 seconds the answer, and they make the decision. But most people with these advisors do not know about compound interest and how much 1% really means.
right.
And they think that, well, they want the comfort of going with somebody else because somebody else is going to save them. And I got to tell you, folks, nobody's coming to save you. You got to save
Hmm.
yourself.
Yeah, we've
That's a
all learned
stubborn
that the hard
fact.
way, I think.
That's a step that, and the thing is, Wall Street is really good. I mean, they're really good at selling. They're terrific. They're
Totally.
slick advertising, and they're really nice people. They're all, articulate and polite and, and smart, and that's great. And maybe they can make money for you after their fee. But the first question to ask any investment advisor you're considering is how much money are you going to make for me after your fee compared to the
Yeah.
market, compared to what I could do on my own, right? I
Well,
mean,
Andrew, I want to ask you this though. So I think a lot of people are scared of investing. I think they're really confused by it because they don't understand it. But a lot of people have this misconception that investing is only for wealthy people or high educated people or people that are, in business in the business world. Why does that happen? And can you kind of debunk that myth for us?
yeah, well, I'll tell you, the fact of the matter is that everybody has access now to prudent investment vehicles. Like I have already talked about a S&P 500 fund or other funds for that matter. And you can do it for almost no cost. And most of the big firms, and don't have to name them, but I think most people know what they are, uh, will do this for really no fee at all. Okay, they'll help you. Now, if you hire them to manage your money, they're going to charge you money. Then that we talked about that. But the yeah, you don't have to be intimidated by this at all. And the other thing is that, we all know that 30 years ago or 25 years ago, we didn't have Amazon. And you had to. Now most people know what Amazon is and how they use it, and they can trust it, and they can get a good value, and they can compare prices, et cetera. And they get it the next day, and they can return it the next day if they want. If they don't like
Yeah.
it. So things have changed. The one thing that has changed too is the democratization of investing. So anybody with $100 now can invest in the stock market,
Hmm.
and they should. And the other thing is that the sooner they do that, the younger they are when they do that, the better off they're going to be, because the most important thing that any investor has is time.
Right.
Time's on your side. Okay, it's not against you. Okay. Time is very much on your side. You have time to tolerate a decline in the market and then recover from it. Uh, you have time to continue putting money into your savings, to your investing, which is very smart. It's called dollar cost averaging. And so you're buying when prices are high and when prices are low, but over time, it's going to compound at a great rate. Uh, and so people should not be intimidated. It's not just for wealthy people. It used to be. I mean, when I got in the business, it was just for people who had a lot of money 50 years ago,
Right.
40 years ago. In the last 20, 25 years, no, anybody can do it. And democratizing, and the biggest firm in the world is BlackRock, actually. And their leader, their Larry Fink, the president and chairman of that firm, says he's all about democratizing investing for people. He wants people to have access to invest their money for the future. That's it. So don't feel intimidated. Don't be impressed
So at
by
what point should people start investing?
as soon as they have any money to put aside at all. Okay. And one of the things I should tell people is this. I really encourage everybody knows how to use the internet, I think. Okay. And just go to a compound interest calculator. Just put that in compound interest calculator and put in, and let's say you could save, you can put aside, whatever it is, $50 a month. Okay.
Mhm.
That's all you can afford to save. The other thing is let's be honest. Okay. You have to make a time preference decision. How much of what I earn am I going to save and how much am I going to invest for the future? And and it's really easy to say, well, I'm just going to live for the moment. You only live once, and I'm just going to spend it all right now. Well, that's fine, except that then, you get 10, 20, 30, 40 years down the road, and you don't have the same earning power, perhaps. And, then you're going to be kind of out of luck. So I would say that anybody can do it, and the sooner they can do it, the better. So go on a compound interest calculator and put that $50 a month in and put in, if you're depending on what your age is, put in 30 years from now, how much it'll be worth 30 years from now if I put $50 a month in and I make, 7% a year or 6% or even anything, any amount. I would say use
Mhm.
7% if you're going to put it in the stock market. And you might even do better. You should do better than that over time. But, then see what the number is. And you're going to say, oh my goodness, that I didn't realize that I could have thousands of dollars or maybe hundreds of thousands of dollars just by putting a little bit of money in every month for the next
Right.
40 years. I mean, the numbers are astonishing, and it's just compound interest. It's like it's that, and that's one of their superpowers is to understand compound interest.
Yeah, I think
And
it's just
everybody can
understanding
do
the
that.
terms and, like you said, seeing the effect of it, and like understanding how, that 25 or $50 a month that we all have to invest, how that can make a difference for our future. Like it would be such a secure feeling knowing that you have something that's going to be there 30 years from now. Um, but some people try to invest and they pick stocks, they watch the market, they're doing everything themselves. Why is that sometimes like the most inefficient thing for most individuals? It's like they're trying to outsmart the market. I feel like that leads to a lot of bad decisions.
Well, it's almost like, unless you're emotionally, ready, okay, for the uncertainties of investing in a single security or even a small number of securities, then you shouldn't do it because you have to manage your risk a lot more carefully if you're in a single security. Now, having said that, I know that there's a whole spectrum of fear and greed that we live with. Okay.
Mhm.
And people say, "Oh, I can make a lot of money really fast if I invest in this stock," and maybe they will, and people have. Okay, uh, but it also works the other way. Okay, and so it's a very, very difficult thing to do. What I would say to people is if they have, what they should do is they should put the majority of their money in something that's solid and diversified, as I've already said, like a broad market index, like the S&P or others. There's a total stock market index that all these firms have. I would suggest you use that. And by the way, international stocks have been doing really well lately because the dollar has been weak, and so you should probably have some international equities in your portfolio as well. But putting that aside, and then put a smaller portion in that section, those stocks that you really think are going to be hot. They're going to do really well. And just remember that if you're doing that, if you're doing it in a tax-free account, okay. But if you're doing it in a taxable account, let's say you do make 50% on your money in in a short period of time. You're going to have to pay tax at ordinary interest rates at ordinary tax rates on that. And if you hold it for long term, then you'll pay lower taxes. But still, if you sell it, you have to pay the tax and you have less money to reinvest. Okay.
Right.
So trading, as sexy as that sounds, if I could use that term, or as exciting as that may be, it's tricky, and it almost sets people up for failure because they're going to get in, and one bad experience is going to taint you know, their whole outlook on investing. So, I can't do that. The stock market's too risky. I'm not going to do that. And I can tell you, a lot of people have been there. That's what's
Yeah.
happened. And don't set yourself up for failure. Set yourself up for success. And again, think about the superpower. Compound interest is essential. You know, being resolute and having a durable strategy is essential. And just being patient. Just be patient. You know, I started to say this and I didn't finish it, but in terms of a strategy, often everybody has a plan, as Mike Tyson said. Everybody has a plan until they get punched in the mouth. Okay, and then they don't have.
Uh-huh.
So boxers stand and get in the ring and they have a plan for their bout, right? And they get punched in the mouth and they panic. Well, you cannot panic, okay? And do not do fear-based investing. If you do fear-based investing, you will not be happy. You can't do that. You have to be fearless. And I know this is going to happen. And here's what I'm going to do when the stock market goes down by 10, 20, 30, or 40%. Here's what I'm going to do. And you have to determine that beforehand. And if you don't, then you're going to be susceptible to making a fear-based decision.
Right.
I can only tell the audience that I've seen it. Okay, I've seen it with people, um, and it's very predictable. That's going to happen. So, but it's a mistake for people to submit to their fears, and that's true almost anywhere in anything we do in life.
100%. What is the difference between investing for income versus investing for growth? And how should people start to consider that?
Yeah, well, okay. The best place to preserve the purchasing power of your money has been through stock investing. Bond investing has not been as productive. Okay. It feels safer. Okay. And sometimes it is safer, but it also, no guts, no glory. No risks, no return. Less risk, less return. That's basically what it is. Now, having said that, you know, bonds, and especially now let's talk about investment grade bonds. Okay, the bonds that are most likely to pay the interest and the principal when it's due, as opposed to high yield bonds or below investment grade bonds, and there's more risk there. That's more like owning a stock, actually. And there are people that do that successfully, and good for them. But it's a sophisticated strategy, and I don't think people have to engage in it. Right? But in terms of bonds, in 2022 the stock market was down about 18% that year, and bonds were down about the same, which is pretty unusual. But it happened. Why did it happen? Well, it happened because interest rates have been low for years. The Federal Reserve System in March of 22 started raising rates, and interest rates went down a lot. I mean, it went up a lot, and then bond prices went down. And that's what happens. When interest rates go up, bond prices go down. So your return is lower or negative, which it was in 2022. So just because you own bonds doesn't mean that you're safe from a decline in value. Okay. It could still
Right.
happen if interest rates go up. So just have to understand that. And I talk about that in my book. And again, you know, I think it's really important for people to invest in themselves. And whether
Mm-hmm.
that means, you're walking every day, or you're training every day, or a few times a week, or reading a book or whatever. I'm just saying you have to invest in yourself. And I would just say you probably would be making a good investment in yourself if you're concerned about the stock market. Just take a look at my book. It's not a long book. It's not heavy duty. It's pretty conversational. At least I tried to make it conversational. And it's a story about me. It's a real story. It's my reality. Okay. It's not a textbook. Uh, it does have definitions. It does have stuff like that. But it's really just a story about what happened in real terms. I mean, I talk about some things that happened with clients of mine. I don't name names, of course, but in one case, I had a client, and I don't even, a very wealthy New York City-based client, okay, and this client had an allocation in something called Madoff Securities, and this was back in the late '90s, and we did some work and analysis, and we couldn't figure out what he was doing, so we told the client, this was in 1998, we told the client to liquidate that allocation, to get out, to sell, which he actually did. And then 10 years later, the world found out that everything he was doing was fraudulent.
Wow.
Madoff, Bernie Madoff, I think people might remember who he is. And does that because we're so smart? No, no, no. It's probably the opposite. It's because we just look at things for what they are, not for what we want them to be.
Right.
So, and we couldn't figure out what he was doing. And we said, hey, look, this doesn't feel right. It doesn't smell right to us. And, nothing fit together. And it turned out that it was a complete fabrication and fraud. Okay. And fortunately, she got out 10 years before the whole thing exploded. So other people were not so lucky. But yeah, and so not because
I
I'm so
guess that makes
brilliant.
me want to ask you the question of like risk. So, how do you make a smart risk compared to a reckless risk? Like, I know investing, involves risk, but what is a smart risk compared to something more reckless?
Yeah, well, first of all, there's a big difference between risk and uncertainty. Let's talk about risk. I think you can measure risk in investing. And why do I say that? Because human behavior really doesn't change. It moves in cycles. And what happens in the world, the natural world and the investment world, is things tend to have an average. They tend to return to an average. So there are extremes. There are extremes of fear and there are extremes of greed, but there's an average. So we can measure that whole experience over time and come up with some probable outcomes. Okay. So that's how we assess risk using probability analysis. And it's very sophisticated stuff, but it works. And I can say it works because I've used this same approach in my business for decades and it works. Uh, so that's how you assess risk. the One of the things on this Madoff situation that I'll say is the reason people were throwing money at Madoff is he was making 18% a year with almost no down months. Like that's too good to be true. That's what I
Wow.
thought.
Yeah.
And of course, it was too good to be true. It was a fraud. But people look at something, say, I want. So don't be. The fear of missing out is a big risk.
Yeah.
Okay. I mean, it really is a risk. People have to understand that. And what happened in the late '90s, for example, in the stock market before the dot-com crashes, people in 1999 were projecting that, oh, the stock market's going to go up 18% a year forever because that's what it's done in the last 10 years, which it had done. Of course, it didn't do that. For the next 10 years, it actually was flat, didn't do anything. Actually, people lost 3% a year for 9 years after the dot-com crash. So, so yeah, that's risk. So assessing risk and understanding how much you can tolerate before you exceed it is an essential element of any investment program. And that's one of the things that I would help people determine. And yeah, and my whole approach is laid out on my website. And there's a there's a 2-minute video on the homepage of my site that explains it. And I think it's pretty straightforward. And and for whatever it's worth, and I think it's worth a lot. I'm always available to have a Zoom call with anybody if you want. Schedule a Zoom call. We'll talk about it. Doesn't cost anything except time. I'm happy to do it. And why am I doing this? Like, I don't need to do this. Okay. I don't need to do this. I want to do this because it's the thing that I think is the most valuable thing I could do to help others.
That's important. It's important that, um, I mean, when your motivation is to help other people succeed and have security for the future, that's different than a motivation of someone who is in it for the money. This is what you've worked your life up to, and now this is your way of giving back to the world to help people learn about investments and money and what's reckless and what's not. And I think the biggest issue is that people just don't understand it. And as we talked about before we hit record, is people are scared of money. People see a bill and they don't even want to open it. And so I think we need to start normalizing money and not looking at it from a negative standpoint. Like it's not scary.
No, it's not. It's not when it's such a, I had an interview by the guy that wrote the foreword to my book. And at the end of the interviews, he asks my response to some key words. And he said, what's your response when I say the word money? And my response was confusion.
Yeah.
People are confused about money.
Yeah.
And, and I think that that's it. You have to face up to this reality that yeah, it is confusing. It doesn't have to be, we need it to survive. And, and oh, by the way, money buys us time. If we have money, we have time. If we don't have money, we don't have any time.
Hmm.
All right. So that's what I'm saying. You do this investing, you're buying yourself time in the future.
Right. What about emotions? I know people freak out. They let their emotions kind of take over. How do emotions sabotage the investment process? And how do you recommend, managing that as humans are pretty emotional beings?
Well, all right. For start, I've said this a few times, but the most important thing is to understand your tolerance for risk before you exceed it. How do you possibly do that? Well, is to do some testing. Is to say, okay, and this is how I would construct a portfolio for somebody. Is to say, okay, and the questions are something like this. Okay, so for your $100 over the next 6 months, are you comfortable if it goes up 20% or down, 8, not 10%? Well, down 10 is a lot. I don't like, but so okay, well, how about if it goes up 15, but it's only down like 7? Well, that's a little better, but I don't still want it to go down 7. Okay, how about if it goes up 10, but it goes down like 4? Well, that's getting closer. Now you can get to the point where you say, look, I don't want it to go down at all. Okay. But then your return is going to be like 3%. Okay. Maybe. And if that's okay with you, that's what you do. All right. Then you won't have any fear. You also won't have any return, but you won't have any fear. I mean, you'll lose money
Right.
to inflation. I mean, one of the numbers this is kind of weird, but I did it the other day for this informal group here in town that has a bunch of senior people involved. That I said, okay, if you had put $100 in the Standard and Poor's 500 50 years ago, you'd have $28,700, I think the number is, at the end of last year. If you just left your $100 in a safe deposit box, it would buy $16.65 worth of goods.
Right.
That's the difference. The $100 went to $28,000 if you had it invested in a retirement account. But if you didn't invest it, you just put it in a safe deposit box, it would have only been worth $16.65, I think. Yeah.
Wow.
Now, 50 years, for somebody my age, 50 years has gone by pretty darn fast. Okay. But
Yeah, time
I
flies.
guarantee it's going to go down. It's going to go by fast, whether you're 15 or 30 or 20 or doesn't make any difference. It's going to go by fast. So just understand that time is your friend when you're investing money, and you should be, the younger you are, the less concerned you should be about losing that money.
Right. True.
And oh, by the way, if people think that they're always looking at the difference between like Armageddon or Nirvana. Okay, oh my goodness, everything's going to end, or no, everything's going to be wonderful. No, neither one is going to happen. Okay, and and by the way, if Armageddon happens, then last thing you're going to be concerned about is money. I think, but and Nirvana doesn't happen either. Or if it does, it only happens for a minute and then it goes back to normal. So just understand that there's going to be some middle ground, and risk is, you have to assess risk. And that's what my whole uh, practice is about, is to help people assess risk and to deal with the emotion around money,
Yeah,
because it's an
the
emotional
uncertainty is
subject.
the biggest part. The human brain is designed to want certainty. And so as soon as there's an unknown or there's no answer, it makes people crazy. Like people need to understand, A, good things take time. If you don't take any risk, you're not going to get any reward. And you don't need to know. You just have to trust and believe. So yeah, I think that neuroeconomics of investing gets in the way, and that's what holds a lot of people back. So Andrew, if someone out there is listening and they're like, "Oh, I really want to get started. I don't know how to do this." What would you tell them?
Well, again, I would suggest to just listen to this broadcast again or podcast again. Uh, my book is probably a pretty good place to start. There are other books on the subject. I will say this, that my book, I'm probably the only person in the world who would write my book, okay? Because I basically call out Wall Street, all right, in my book. You don't need Wall Street, folks. You don't need it. And, Wall Street needs you. You don't need it. All right. So I would say that the way they do it is just read my book. It's on Amazon, and there's a link on my website to it and such. Read my book. The people who have come to me have read my book, and they've looked at my interview with the guy that wrote the foreword to my book, who's a pretty well-known investment guy. Uh, and they've also done a Zoom call with me. It's like, check it out. Uh, it doesn't cost you anything. And well, by the way, you have to understand, as I've already said more than a few times here, that 1% fee that these wealth advisors charge is quite a bit of money. And you might be comforted by the nice office and and so forth. But, you have to understand what you're paying for and what you're getting. And that's it. That's really it.
Yeah.
Anybody can do it, and everybody should do it. And yeah.
Amazing. Well, I am really looking forward to this series with you where we're going to break down these terms even more as we go on. Thank you so much for being here today. Is there any other last minute things you would like to leave the audience with today?
Uh, no, I just think that, I just want people to understand that they are in control. There's nobody there to save you. They're gonna save themselves. Okay. And to just take the responsibility and do it, and don't put your faith into something that is, or if you do put faith in something, make sure you know what it is, and
Hmm.
make sure you know that you're going to get value in return. And I say faith, that's a strong word, but that's really what people do. People have faith in wealth managers, thinking that somehow they're going to protect them. And I could say with a high degree of confidence that the wealth managers are not going to protect you in a stock market decline. Now, they're going to tell you to stay invested, which is the right advice. But do you want to pay them every day? Do you want to pay them a fee every day of the year to tell you once every 3 or 4 years, oh, stay invested, the market will come back?
Mm,
And it, you know, and by the way, if you do get to that point, you could always just call me and I'll tell you the same thing for nothing.
right. Andrew, it's been so much fun talking to you. I thoroughly look forward to the next episode. Thank you.
Oh, thank you, Lisa. Okay, take care.
Yes. And to our audience, thank you so much for tuning in. For some reason, I have the urge to watch The Wolf on Wall Street right now. Don't be afraid of money. Get the information, learn about it, and don't let fear hold you back from protecting yourself in the future. We'll make sure to have all of Andrew's information in the show notes for you so you can easily access his free tools on his website, including the calculator that we talked about today and a link to his book and where you can find more information about him. Please take care and take care of that money situation. It's not scary, I promise. Until next time.